Now, a status quo policy is almost a given today, but the Monetary Policy Committee will be weighing the risks to inflation as well as the fiscal deficit on the one hand and the nascent economic recovery on the other. Does this precarious balance allow the RBI to review its hawkish stance, if you may call it that? Well, we're joined today by Indranil Sengupta, Chief India Economist at the Bank of America Merrill Lynch. Good morning, Indranil. Thanks very much for joining us. I imagine that you're in consensus with every other economist and analyst out there saying we're not going to expect a change in rates today, but you are holding out for one rate cut later on this year, which is not necessarily the consensus. Talk us through what you think the inflation trajectory will be and why you think that rate cut might happen in August.
Well, we see inflation coming down to 4.1% in March from 5.2% in December. It's true that, inflation will jump back to 5.5% in June and in September because those 2 months have strong base effects. But inflation will again fall, to 4%, maybe marginally below 4% from thereafter, after September. So, inflation will remain well within the RBI's 4% plus minus 2% band. And as you can see from a fundamental perspective, growth still remains weak once you take these base effects away. Liquidity is tight. Looks like the rains are going to be normal. Our house view is that oil prices have peaked. So when you take a look at the fact that Brazil, Russia and South Africa are cutting rates, despite the Fed hiking, the fact that there is a sufficient cushion against the Fed hikes, we think that there is a very strong case for the RBI to cut rates and support growth by bringing down yields.
Okay, without disagreeing with you, can you give me what you think might threaten that view of yours? Which change in economic conditions will then prompt you to think that maybe that one loan rate cut in August is unlikely?
Well, I think, the biggest challenge is from oil. If oil goes up much from here, then that is something to worry about. If rains fail, optically at least inflation goes up. And while, the RBI monetary policy is obviously not going to sow crops, I guess they will halt. But these are the two big questions, oil and water.
Okay, that's an interesting comment. Indranil, good morning. Neeraj here. What about today? I know the status quo is given. Would you believe that a change in pattern of the MPC votes or views could also move the bond markets ever so slightly?
Well, it remains to be seen if the RBI acknowledges that inflation has peaked off. As you know, they were looking at 5.1% average for the March quarter. We are going to get 4.6%. Secondly, it remains to be seen, whether they acknowledge that they have to provide durable liquidity on a steady basis. We estimate that you have to provide about $37 billion this year. FX intervention is going to be much lower, which means that the RBI will have to do far more of OMO, buybacks, a bit like 2016. Now, in 2016, as you know, bond yields fell 150 basis points. So, it looks like 2018, 2019 is going to look more like 2016 than 2017. Finally, we are awaiting what they say on MSP hikes because, now the government has clarified that it is going to be, the A2 plus FL farm cost. And that means that the inflation impact is going to be very marginal because a lot of the revised MSP price hikes are already going, are going to be below the market prices.
Okay.
So I think markets will wait to see what they say on the inflation peaking off.
That's interesting. And I know you've been holding this view that inflation will be lower than what the stance would be. Just wondering, average, do you think inflation could be circa 5%, or do you believe it could be trending lower, and will that give a bit of a relief to the Reserve Bank of India? I mean, I can understand month on month there will be certain months of peaks and troughs, but average 5% or average about 4.5 odd, according to you, for FY19?
See, I think yeah, if the rains are normal, the average will be, between 4.5 to 5. If you adjust for these, base effects, it'll probably be 4.5 or slightly below that.
Okay. Yeah, I just want to bring in a couple of other unquantifiables at this point in time, Indranil, and ask you what your view is on that and whether your medium to longer term view, therefore, on rates this year changes substantially. Also, in connection to the fact that we've seen finally some relief on the bond end of things, right? So, tapering off of the 10-year yield in some fashion. Do you think that this might be a year characterized also by some populist noises by state governments and maybe even the central government as we head towards critical state elections and then of course the big central election next year, as a result of which a lot of the main calculation that you're doing on, and not just you, but the entire economist community is doing on rates, etc., might alter or have to be modified?
Well, it is but natural that, as we approach elections, there is going to be higher rural public spend. And, if you see the rural strain that is evident in, farmer as a movement after farmer movement, I think that is certainly desirable from a national point of view as well. For such farm relief to spill over into inflation to such an extent that the RBI has to cut down growth, I think is taking things a bit too far, because we are below potential. If you look at where growth is, we are at least 150 basis points below potential. How will growth push up inflation when it is not even at potential?
Okay. So in that case then, the tapering off of the 10-year that we've seen, especially in the last couple of weeks, on the back of two things, I think. One, of course, the borrowing calendar details that were put out by the government. And secondly, this, RBI relaxation in provisioning at the bank end. How convinced are you by the borrowing calendar details? Do you believe all of it is already baked into bond prices and yields at this point in time? Is there the likelihood of a disappointment at all, as a result of which you might see some reversal in yields as we go into April, May?
Well, April, May is difficult to say because that's when supply picks up. But from a 2018, fiscal 2019 perspective, I think that the macro risks in the bond market are grossly overdone. Like I'm saying that, inflation is peaking off. The fact that FX flows may be lower this year means RBI will have to do much more of OMO, and that will support bond yields. So, clearly, the future is very much on the side of the bonds.
So you're saying that even if we don't hear any, sort of clearly dovish notes from the RBI today, even if that August 1st rate cut does not come through as you anticipate, yields from here onwards are on a downward trajectory?
See, there are two things. One is that, you follow the fundamentals. Policymakers also will have to look at the fundamentals and follow, beyond a point. So that's number one. And number two, when you look at the demand supply, it's very simple. If you get FX flows like you did in 2018 or 17, the market, RBI will have to, exit the market, which in years like 2016, years like 2018, if FX flows are less, the RBI will have to buy more bonds. So last year you had open market sales of $13 billion. This year you could end with about $20 billion of open market purchases plus buybacks. So that is the big swing factor that will support bonds this year. Right now, obviously it's been like a falling knife. Good news doesn't, necessarily resound in bond markets, but that does not mean that good news does not exist.
Indranil, what in the policy today with regards to maybe the FI investment limit could move the needle on bonds? Because a bunch of media houses have reported that the finance ministry and the RBI will raise it maybe to 6 to 7%, eventually to maybe even 10%, but that's anybody's guess. But something in the policy today that you think could move the needle?
Well, it could be, I think that, any increase in FII limits in bonds is welcome. But it boils down to the same thing that, once the market gets that comfort that inflation is over, that, maybe FX flows are not really coming and the RBI will have to step in, everyone will come to buy. So there at the margin, while this is good, in the overall, whether you bring in 1% over, higher or lower, will not make a distinctive difference, because those players will also mimic the same domestic players, in the sense that if they do not have certainty, they will not buy. If they have certainty, they will buy. If for example, you still think that there might be some policy pronouncement because of which yields will go up, then why will you buy? So the behavioral character of whether you are a domestic player, whether you are this new FII, is going to be the same.
All right, Indranil, one final question to you, and a quick one at that. I think for the last few months, it does seem to all of us that there has been a minor upturn, at least the addressable upturn in the economy. As you see it from here onwards, what do the next 6 months look like to you? Where do you see the recovery concentrated or focused?
Well, the next 6 months, all numbers, GDP numbers, credit growth numbers, earnings numbers, everything is going to look great, because there are very, very strong base effects. So GDP growth could go to 7.5%, for example. But then after that, we think that, again, growth will head lower because interest rates are still high. So on the whole, we are looking at about 7.2% growth for the full year versus 6.5% last year. Of course, that 6.5% was because of all these disruptions which are now behind us. Right. So this year will be like, you will see growth going up a lot on base effects and then coming off towards the end of the year.
All right, Indranil, we'll leave it there. Thank you so much for joining us. And that was a quick preview on not just what to expect this afternoon from the RBI or the Monetary Policy Committee meets decision, but also over the next few months what Indranil Sengupta believes will be the trajectory for inflation and bond yields.